most bullish thing I can see for gold is that governments have become addicted to printing money. And I think the general public has consistently voted for governments that are willing to spend more money, even if that entails borrowing. And that's a really positive sign for gold.
Today's guest is a supporting sponsor of Liberty in Finance.
Welcome back to Liberty in Finance. We're delighted to have this returning guest. Frederick Bell is the CEO of Elemental Royalties. He joined us for the first time late last year and had just announced a doubling of the asset size under management of Elemental Royalties. And today we have a brand new announcement that ties back to that original announcement about this increase of new acquisition that happened late last year. And Fred, if you could please let our viewers know what's the big news right now about that acquisition that you made last year that you told us was going to be holding great promise and scale for the company.
Well, I think the big news is that this is a quarter it all happens. So this quarter, the mine comes on stream. It's already had first gold pour, and it's ramping up to full commercial production by the end of September. And this is a long life, more than 10-year mine that will be a cornerstone for our portfolio. And so, going back to that last interview that we did, where we made this acquisition and we said this is going to be a really key asset for us. I think really pleased to see that mine be successfully built, commissioned, and brought on stream on time and on budget in a COVID world where you can't necessarily take that for granted anymore.
And also, when we talk with a lot of discovery companies, that exploration, there's hope and there's possibility and there's probability and there's statistics and there's looking and searching. But this is something that has come to fruition. And can you talk to us about why the scale of this is so significant for Elemental Royalties?
Well, it's in one swoop. This royalty almost doubles our revenue on a year-on-year basis. And since we started this company privately in 2017, and we've been listed for a year now, we have public accounts, we have doubled our revenue year on year. And this royalty will almost be doubling our revenue again, single-handedly. And when you've got a long life asset like this, a brand new mine in Australia, it's Australia's newest gold mine, that's going to be, in our view, around for a lot longer than the existing 10-year reserve life that it has today. And so I think for us, not having to do anything for the rest of that life, we get the royalty payments irrespective of anything else. That gives us a lot of value today, but also a huge amount of optionality going forwards. Exploration success, discovery success, optionality on the price of gold that we never have to pay another dollar for.
Before we started recording, you and I were talking about other financial impacts to your company, to Elemental Royalties, of this turning of the page, so the realization of this start of production from this promising asset, because it's going to allow you to actually not only just start getting the revenue stream, but you're going to actually start reducing your financial costs.
Yeah, so we've said all this year, and I think and when we took the acquisition as well, we took out a loan credit facility, $25 million as part of the payment for this. And one of our really key objectives was to be able to refinance that in the second half of this year with the mine coming on stream. And we think we can do that at half the cost that we did previously. So that alone saves us, more than $1 million a year. And so if we're adding $4.5 million a year of revenue, and we're taking away, over $1 million of cost, that is why we did this acquisition. It's taken the mine until really this quarter for it to really start to see the impact. And I think Q3 onwards, we will have the impact of this royalty coming in for us and really be visible. So we're just at that inflection point now for a royalty company, where every $1 million of revenue we add, we're not necessarily adding any costs. We don't have to operate these assets. If we buy another 2 royalties, we don't have to hire anyone else on the team. So we're at that stage now where every $1 million cumulative revenue we add, it's basically going 90% plus to free cash flow. And that's why it's a very scalable and powerful business model. And the hardest thing to do is to get that critical mass and scale from the outset. And that is what we have achieved. And when you talk about discovery and exploration, you have those risk profiles. Elemental today with this royalty is 80% of our portfolio by net asset value is on producing de-risked assets. And that is unique in the royalty space. 100 million market cap company with a portfolio of 80% producing royalties. That's much more common in the major multi-billion-dollar royalty companies. And I think that is where we stand out. It's why we will be able to access credit facilities with some of the bigger banks. It's why we will be able to generate, more and more free cash flow going forwards from these revenues coming in.
I know we don't offer personalized investment advice, and we don't promise future gains or whatever. But it does sound like that last dynamic that you just mentioned is if investors are looking for a investable gold royalty company that's small and growing, potentially rapidly growing here. But you're saying that unlike many other really small royalty companies, your assets are not just promising, they're producing. So, or 80% of them. So that's a very interesting combination.
I think it's what we've always tried to say in a short one-line summary, is that we have that growth upside, that growth runway that a small $100 million company does, where we've doubled our revenue year on year. But we also uniquely have that de-risked downside. So we have diversified revenue from multiple assets, multiple operators, multiple countries from the beginning that gives us an asymmetrical risk profile, low downside, and still that growth upside that a smaller company has.
I've asked you to send me a copy of or link to the press release that we can add to the description of this video, so that all of our viewers who won't look at the description of this video, or folks, if you signed up for our free newsletter at libertyandfinance.com, you'll be able to get that link to the press release. Fred, we've also had well, first of all, congratulations. I mean, this is a kind of a consummation for us, because we talked with you, 8 months ago about that you were going to be doing this, and now here you are. You've not only done it, but the underlying asset itself has started to produce. So it's coming, the fruition coming true is exciting to see. And we have some questions that are submitted by viewers. You just mentioned in passing there the principle of geographic diversification. This has always been a concern. Well, okay, let's back up. Diversification in general has always been an important element for people in any investment or in life in general. Our viewers are particularly attuned to risk reduction because of our background. The heritage of our channel used to be called Reluctant Preppers. It's about preparedness. Preparedness for what? Preparedness for different scenarios, because the future can bring surprises. And we want to have optionality open. You want to be able not just to have all your story has to work out this way. This is the only way we win, is if life plays out in this way, but having some diversity. Okay. There's a increased and heightened concern more than perhaps ever before in the last year and a half, since we've been through the COVID lockdowns and that sort of thing, because people are really realizing that this idea of preparedness and diversification also can be subject to changes in the control landscape or in the regulatory landscape in which we live. Things can come out of the blue and suddenly change the picture. Part of that has people asking, "Gee, should I relocate?" Should they move their home? Should they move their business? Should they diversify where their income's coming from? Question here from Matt Hauser: how would mine nationalization impact your assets?
So I suppose it's if the short answer is that if a company, if an asset was taken over and completely nationalized by the government, in theory, the royalty still exists. Now it varies jurisdiction to jurisdiction, and it could depend on the mining code in the country. So the more sophisticated a mining code, the more provision there is for these scenarios, and you can tie a royalty to the license itself. So often cases you will have seen in the mining space, if a mining company goes bust and another company comes in and buys it, the royalty will exist through that because it's tied to the licenses in the project. Now, that would be a question of, if the government nationalized the mine, what would they then do to the royalty? And would they still pay that, or would they not? And I don't think I haven't actually seen that happen. So I don't know. I mean, I can give the example of a place somewhere like Tanzania recently, maybe good example last year. They had a very public dispute with Acacia, subsidiary of Barrick, so one of the largest gold mining companies in the world, and they I think they demanded a sort of back payments for what they saw as not enough historic sort of contributions to the country, and they demanded an increased share in the mine. Now, all of this was with the sort of almost implicit threat of nationalization if it doesn't go ahead. And what they ended up doing is the government, they don't want to operate this asset. They don't have the expertise. They don't know how. But what they did is by using that as leverage, they got an increased stake in the mine. They got a one-off payment. They increased their participation in it. Now, if you had a royalty on that mine throughout, a gross revenue net smelter royalty, most of ours are those, it wouldn't have actually impacted you. The worst that would have happened is decreased production in the short term, which for a royalty company is revenue deferred, not revenue lost. So that's sort of one of the benefits. Now, I can't speak for any nationalization, because if a country is nationalizing assets, that's a pretty extreme step. And I think in that scenario, it's sort of unprecedented enough that you don't know how much of the law would be being respected and how much of existing agreements in anything would be. But I do know that in most of these cases where that has almost happened or has happened, the royalty has just sat in the background and persisted through it.
If we could bring the picture up bigger right now, we have a question also from Matt Hauser. In your opinion, what are your 3 most bullish points for gold, and what concerns you about the commodity or sector?
I think the number one bullish point for me, and it's almost I see it at a personal level, and then I see it at a macro level played out, and it's the fact that people on a general level, countries, particularly Western countries, have an ability to basically print money and borrow now. And because it's an emergency and there's a COVID and health risk and that aspect of things, it almost no one talks about the debt in the short term. We actually have more debt today than we did in the GFC as a proportion. You look at Europe. In the GFC 2009, countries like Greece were almost bankrupted, and they were bailed out by the Eurozone. And you look at the ratios of debt that countries have. Well, a lot of major European economies have the same debt levels that Greece had at that point, and yet no one's talking about it. And I think the most bullish thing I can see for gold is that governments have become addicted to printing money. And I think the general public has consistently voted for governments that are willing to spend more money, even if that entails borrowing. And that's a really positive sign for gold. So I think that's one aspect that makes me very bullish. The second thing I see is that one aspect that's always appealed to me in gold is I studied history at university, and the historical relevance of gold, not just in countries where you or I live, but around the world. And you see that when, the US, I think, invaded Afghanistan, taking a travel back, and they actually brought gold with them as a means of payment initially, because you can't go into a country and take US dollars where they have no bank machines, no ATMs, and no one will accept it. But if you can go anywhere in the world, and again, it happened in World War II, they use gold as a form of payment because it is accepted the world over. And actually, 2 of the biggest buyers of gold at the moment are India and China, not in the West. So I think it really does have that universal appeal across thousands of years that I think, gives me more confidence in it. And then I suppose one thing that I would see as possibly, as a risk to gold is probably short term. And I think it is in the short term, people can get very focused on there is $1 billion stimulus plan. So in the next year, there will be a lot of spending, and maybe some commodities like copper and commodities that will go into that economic stimulus will be front and center. But in the background, it is exactly the same narrative of that $1 billion is not money we had in the bank. That is another billion of debt. and that is currencies being depreciated because governments can't afford their debt. So I think that's the most important factors for me on gold.
Back to the geographic question, Ameripride 7777 says, will there be an increase in mining here in the United States?
I think it's a really interesting question. I think that one of the longer term things that might play out is that I think currencies in some of the major economies, it's almost a race to devalue them faster than your neighbor. And a great example is that Switzerland, I think, recently had a negative 0.75% rate if you kept your money in the bank. So you would the bank would be taking money out of your current account to try and encourage people to spend it, because Switzerland were worried that their currency was getting too strong, and that, with European, Eurozone, Japan, US printing money in deficits, Switzerland did not want them to become economic by comparison. And so they put an even more aggressive rate. And I think that one of the medium to longer term impacts of this will be a relative devaluation in the currencies. And one of the really interesting aspects of that is it actually makes mines economic, because, you may still be getting an increased salary every year, but in real terms, in spending terms, it is less. And so you see that sometimes. A great example is Australia, where they have a very big mining sector relative to the size of the economy. And, the strength in the Aussie dollar is directly impacted by iron ore market and iron ore exports. And so if iron ore exports come off and the Aussie dollar weakens, all of a sudden the gold mining companies there are actually more profitable, because the Aussie dollar is stronger and the gold in Aussie dollar terms is higher. And so I think you might see, in the medium to longer term, I think you might see that play out in the US in a way, in that in US dollar terms, gold rises and actually it exceeds the inflation in salaries and costs. And so mines that might not have been economic today or 5 years ago, in the future, those will be more economic, either because of the high rise in price in gold or because the dollar hasn't kept up with it.
That's interesting. I mean, it's concerning, just as the number one mention that you did about debasement of fiat currencies worldwide being a strong bullish indicator for the future of gold. That's also concerning, because it really impacts savers and earners and retirees and that sort of thing. But I see your connection here, and it reminds me back to when we visited a historic gold mine in the Black Hills of South Dakota about 2 decades ago, and we took a tour. And the tour guide mentioned that there was an operating gold mine across the street that had shut down in recent months because it was no longer economic because the price of gold was so low. And the light bulb did not go off in my little contrarian mind at that point to say, ooh, maybe this is a good low point to get into investing in mining companies if they're having to go offline because it's not economic. But you're saying that the race to debase and the race to cut interest rates internationally is maybe unhealthy for some major aspects of our lives, but it can be bullish for mining or bullish for the metals themselves. Got it.
Yeah, for commodities, and it's an interesting point, because I think in the US you might have that balanced against increased environmental awareness concerns in certain states, water usage and availability. And I think in some places in the world, there's increased competition between farmers, agriculture for water, and mining companies. And so it won't necessarily be universal across the board. It may be that some states and some regions in the US will be much better placed for mining projects than others. And that might be partly localized issues as well. So,
yeah, that question of the effect of drought on mining and what the mining industry is going to do about it came up in an interview we did with Rick Rule and I believe it was Mark O'Day. And that's a very key consideration, especially in certain regions. The southwestern US is in a major drought right now and is projected to get worse over the next several years. So there was some discussion by both those gentlemen about changes that the mining industry is doing to reduce water consumption, make it more efficient, reuse, that kind of thing. So it's quite interesting. And as far as the GDP contribution per gallon of water used being higher than many other industries, including agriculture for that matter. We have a question from Steve Fletcher. Where does Fred see Elemental Royalties in 1, 5, and 10-year timeframes? Again, we can all see visions of the future, but you have specific plans and intentions that can give us some insight into where you see this headed.
Well, I to do that, I start with sort of taking a trip down memory lane to 2017, when Elemental was, it was an idea without a form yet, and with $20,000 behind it. And if I look at where we are today, I think the share price is 4 or 5 times up from our first fundraise in 2017 as a private company. Our first acquisition was $1 million royalty. And our last one that we did, closed earlier this year, was a $55 million acquisition. You look at how we have grown the company, built the team, despite COVID, despite spending the last year, most of it locked down at home. We listed from our living room in another country, in another market that we had no familiarity with. And I think that if I look ahead to where we are in a year, even at the sort of most confident level, we will have Carl Winder coming on stream this quarter, and we have a royalty with Equinox Gold, with Ross Beatty's company, coming on in July next year. And that's an existing operating asset. It just starts paying us a royalty from July next year. So even if we did nothing else over the next year, we would have 2 material royalties that are paying us from then going forwards. And I think if I look at the history of Elemental, we have never gone a year without making a material acquisition. So I think that will continue, and I think we've been really busy on that front in the background. Never see it until it happens, but I think 1 or 2 more material acquisitions will be really impactful. And I think the size of our deals have increased as we've grown. Our first one was $1 million, our second one was sort of $4.5 million, then $12.5 million, then $55 million. And as you get scale and critical mass, you get institutional investors, you get access to capital, you can grow the company. So I think in a year's time, we'll have grown the portfolio. And I think that if you consider we'll have double the revenue in a year's time without doing anything else, I think if we can make 1 or 2 judicious acquisitions, we can do even better than that. And 5 years time, I think my own personal view, my belief is that, if we were able to take the company from where we were in 2017 to where we are in 2021, we should be able to do a lot better than that in the coming 4 years, 4 or 5 years, because we've got a better team.
Related question that ties back to your comment about refinancing your credit facility at half the rate. Pacha Papa says, how will Elemental get that refinance loan, even if you get it, which will help lessen the load? It cannot be counted as a technical achievement. Okay, well, but it's interesting because I imagine that royalty companies, it's not primarily technical, it's technical and financial expertise, both, that make that work. But if you cannot get that loan, I see much more downside in the share price. Does the company have a sustainable strategy for growth? Would borrowing money and refinancing always be your preferred means to buy royalties going forward? Or how long would it be until the company is debt-free and cash flowing?
Well, it's actually, I think there's a very rapid deleveraging profile. If you think that broker consensus for next year, we haven't put out guidance for 2022, but I think it's $11 million revenue for next year. That gives us a pretty rapid deleveraging profile before we do anything else. And if you think that, I think we have $6-7 million in the bank now. So net debt is 19 million. And if we're on track for sort of for 11 million next year, without doing anything else, it's actually it's relatively speaking, I think we're in a pretty good position. And I think in terms of the refinancing on the credit side, one point I would make is that there is no sub $500 million royalty company with access to credit facilities with the bigger banks at that sort of 4.5% cost of capital. There is no sub $500 million royalty company with $10 million plus of royalty revenue. We will tick both of those boxes as a $100 million company, in the second half of this year. So I think we will be starting to tick some of the boxes of a mid-tier royalty company. But we're offering that at a valuation which is less than companies with 10-20% of our revenue. And so I don't see the downside on the share price on that. If you look at our assets, those are assets that would fit in $1 billion plus royalty companies' portfolios. Look across the sector of junior royalty companies, 80% are exploration and development assets. We are the polar opposite. We're 80% producing assets. And in the royalty space, the holy grail is good quality producing assets. And that is exactly what Elemental is. And so, actually our portfolio would fit in and have a lot of value in some of the big royalty companies, where I think a lot of our peers wouldn't. And so on that side, that's why I say we have a de-risked downside, because these assets will always have a value. Good quality producing royalties are really in demand. And so I think from where we go, this is always the same share price that we were this time last year. And yet, if you look at the operational side, if you look at the assets, we have a much, much better portfolio, more diversified, a longer mine life across the portfolio than we've ever had, weighted towards tier 1 jurisdiction, which we never had before. And I think if we can have access to credit facilities that most of our peers could only dream of, then I think it puts us in a really strong position. And to give you an example, when we look at royalty acquisitions, particularly with some of the big companies, one of the questions they'll always ask is, how can you have access to capital? And how do we know you'll be able to complete this deal? And if we can show them that all other things notwithstanding, we have access to credit facilities and can close the deal using that, it really helps on the business development side. So it doesn't necessarily mean, in answer to the question, that we would always use debt as we're going forward. We don't want to have too much debt in the company. But what it does mean is that we can use a credit facility to close the acquisition, and then subsequently we can do a fundraise. And that is a big risk, because when we started this company with $1 million fundraise, one of the challenges we had was that we would go to royalty owners and they would go, well, we're not even sure if you can afford to buy this. We're not sure you'll be able to raise the money. And then you've got that chicken and egg scenario. They want you to raise the money first, but to raise the money, you've got to show investors you've got a deal. Whereas with a credit facility, you actually bridge that, because you can use the credit to close the deal, and then you can show investors we have done this and raise the money subsequently. And I think the last acquisition we did before South 32 on the Wang Yon royalty was a very good example of that. So we bought that royalty at the start of 2020, and we had an $8.5 million US loan for that. And 7 months later, we repaid that loan when we listed the company and we did a fundraise. And what it enabled us to do was it enabled us to close a deal the size of the company at the time and then take it forwards. And the South 32 deal was another deal the size of the company later that year, once we were bigger. And again, we were able to use a credit facility that had a minimum 6 month term on it. So we couldn't repay it in less than 6 months. And that expires in July. And it has a 2-year term out to 2023. So it gives us that financial flexibility that I think very, very few junior companies have.
I would imagine too, and I think you've touched on this, that the proportion of your assets that are producing assets makes you able to then secure those loans at not only at all, but at favorable terms, and then being able to refinance them demonstrates that track record. Fred, is there any further thought that you'd like to leave with our viewers about Elemental, how they can find out about more?
I think we've tried to, unfortunately, still haven't been able to get over to Canada and the US in person since we became a public company, not once. So we're hoping to September, October this year. I think travel will open up a bit to Canada, maybe not the US yet, but to Canada. So hoping to get over in person. But until that point, the best way is the website. And we try and put sign up for newsletters and go on our website, and we try and put links to media interviews. Our announcements are all there. And last and most importantly is always feel free to email us or call us directly, because we do actually enjoy talking to investors. and shareholders. So anything that isn't answered, please reach out to us directly.
Very good. And we will put a link again to your press release about this switching to production for your new asset that you acquired at our last interview. And just thank you for joining us here again on Liberty and Finance.
Much appreciated, Dan.